they in advance make allowance for uncollectible to make sure that our planning is not disturbed. Right, guys? So what happened to this? How we are create? So this 80, from which method it came from, we will learn today. There are different methods to create this allowance. We see history, we forecast with the sales, and we talk about that. Okay, among our 1,000, this much number of dollars, they are not going to be received, so that our planning is not disturbed. Now, can we receive? Can we have no bad debts or no or zero uncollectible? Yes. In that case, our forecasting is true. We still have more surplus. Don't worry about that, right? So in that case, a shrewd manager or a smart manager, they incorporate this kind of, you know, allowances in their planning so that the plannings they are not disturbed and the cash flow they are not also disturbed. So that if they are ready to, invest somewhere in other projects or ready to give money to the other people or pay their liabilities, they must have cash at the end. We'll talk about this allowance in our coming slides as well. The last issue was measuring and report the expense associated with failure to collect receivable account. What happened here? So that uncollectible expenses, uncollectible, accounts, for example, people didn't pay us, so that will go to expense. So all the people who didn't pay us, that becomes our expense, and that expense will go to income statement. So we'll talk about that. So these figures, they are fictitious, so don't worry about that, where this 8,000 came from, what is this 190, okay? So don't worry about that. So we'll talk about over there. So remember that if customers are, they fail to pay us, so that customer amount becomes our expense, and we charge that expense to uncollectible account. On in other books we call that bad debts account, and that is our expense. Okay, and that will decrease our profit, right? So say less expenses, more bad debts or more uncollectible means reduction in profits. And now, obviously, talk about the evaluate collectibility using allowances for uncollectible accounts. So I gave you all this, information in advance, so that to build, the basis how we are going to collect, how we are going to allow to make the reserve or allowances for uncollectible accounts. Now, benefits of selling on credits. Number one, customers can buy on credit, so sales and profits increases. We talked about that. The cost are uncollectible accounts, and when uncollectible accounts occurs, it gonna increase our expense. Now allowance method. Records collection losses based on company's collection experience. If you have a history of business, then you know that on average, on our $1 million sales, $1,000 sales, normally, the people, they are defaulted, they don't pay us or bankrupt whatsoever. So you record it on the basis of history as well, right? And that 1,000 you charge to the income statement, right? So there are other methods as well. So rather waiting whole year to calculate how much the account receivable we didn't receive or how much the customer we how much the customer didn't pay us, rather waiting the whole year and then calculating 1,000, you in advance record this 1,000 as reserve or allowance at the beginning of the year, so that your planning or your cash flows, they are not disturbed. Your planned payments, they are not disturbed, right? So remember, you are making allowance for uncollectible debt. So that is a contra account for account receivable, which means this is the opposite account of account receivable. If account receivable increase, it's debit. So the contra account is allowance for uncollectible. I just write uncollectible. If that increases, it means that credit. So that's why we call this contra account, opposite account of account receivable. We also, studied this contra account when we talked about the entries of depreciation. We talk about the allowance for depreciation, accumulated depreciation allowance, right? Over there, we talked about the contra account stuff. So this is the same logic here, but this time the contra account is for account receivable. So amount of receivable business expects not to collect. So this is expectations or forecasting, not this is the actual amount of that is not going to be collected. Okay, guys? Let's move forward. So how we are going to write it down in balance sheet? Under current assets, we have a cash, we have accounts receivable. So accounts receivable less allowance for uncollectible. For example, this is 25. So here we go. On balance sheet, the allowance is written as 475. For example, if 20 people they didn't pay us, so that 20 people going to be charged here. Balance sheet going to be 500. The 20 bad debts occurred, so we charge those 20 to the allowance. Only allowance left 5. Right? So in that case, what happened here? Our planning is not disturbed. So here, account receivable, here we go. 25, we charge it with 20 here, and plus the 5 remaining account, so that it remains 475 as well. 20 belongs to the actual, and this is the allowance left. Why I cannot write it down here? Allowance, this is allowance left, right? So 20 actual occurred, we charge this actual 20, and then 5 is your allowance. So that the actual only disturb the allowance, our planning is not disturbed. Right? Understand? Guys, I need your response. Chloe, Ajim, David, Junpyo.
Yes.
Yes, I do understand. I'm just.
Okay, right? So how we are going to calculate this? It's on coming slides, so don't worry about that. Where this 25 came from, we will learn in our coming slides. So just going to give you the idea how we are going to present accounts receivable in balance sheet. It is presented as the accounts receivable less allowance for uncollectible debts, and here we write down the net value. This net value is called net realizable value, NRV, okay, which is account receivable minus its allowance. That's it. So anything happen in actual, it will disturb this allowance, not this NRV, so that our planning is not disturbed. Or we can also write it down as account receivable net of 25. So what does it mean? The total account receivable would be 475 plus this 25. It would be 500. We can also write it down. So they are the alternative presentation of writing down the account receivable. Right? Let me show you one more time. We have one method here to present the account receivable as full value minus the allowance NRV, or we directly write it down the NRV and we write it down here net of 25 as an allowance, and then rest of the things, inventory, PBD expense, total current assets. Here we go. So this is our hardest part of this lecture. If you understand this one, then it's a piece of cake for you guys. So there are two basic methods to estimate the uncollectible account. Number one, percent of sale methods. So you see from your history and you find out that 2% of sale or 1% of sales are normally, our bad debt. So rather waiting the whole year and calculating the actual bad debts, we in advance incorporate 1% as bad debts in advance. It means we are making allowance for uncollectible debts, uncollectible account in advance 1% of sales. And then we compare at the end advance versus our reserve or our allowances versus the actual one, so that only amount that is hit is only the allowance rather than the actual amount, so that our planning is not disturbed. So number one, percentage of sales. So this is called the income statement approach because it's based on sales. Sale is an income statement item. So normally this method is called income statement approach. So if question occurs and it calls you that we allocated account allowances for uncollectible account based on income statement approach, so automatically you understand that this is talking about percent of sales method. The next one is aging of account receivable. So aging of account receivable is basically balance sheet item. So you can guess that this is balance sheet approach, right? So let's talk about this one by one. Number one, percentage of sale method. How we are going to find out the uncollectible account expense? Simple. The percentage multiplied by sales, you have uncollectible account expense. That's it. So you predict that this much is going to be our expense, and that you made an entry. When you create entry, so there must be it at least hit two accounts, right? Remember our journal entry rules. At least two accounts.